Most people turn to buying options because it's a cost-effective way to control 100 shares of stock. However, if you're anything like me, you've probably lost a lot of money buying options. Today, I'm going to show you how to actually do put and call credit spreads, which is a low-cost strategy to actually collect income from your trades without needing a massive portfolio. Yo, what is going on, Premium Chasers? Welcome back to another episode. Today is all about put and call credit spreads, and I wanted to share this one with you guys because a lot of the stuff that we talk about on this channel does require you to have, at least, 10,000, 20,000, the more money you have kind of portfolios, the more money you make, right? With the wheel strategy, quad options. And a lot of you always ask me, it's like, Pete, what are some cost-effective strategies that we can get into if we're still working our way up to having a larger portfolio to be really maximizing our returns on the wheel strategy? That's why today's video is all about put and call credit spreads. Stay with me this whole video. I have a great bonus for those of you that stay till the end to make this a lot easier for you. This is a little bit more of a advanced strategy. It's kind of, I would say, like intermediate, right? It's not super confusing, but I'm going to do my best to explain this to you in the simplest way possible. A lot of people on YouTube that I watch, and especially with videos like this, they try to complicate this stuff. So you buy like a $10,000 course from them. You don't need it. Go invest your money. You are always better off doing that. So grab your coffee, grab your water, whatever you got to do. First and foremost, right? The reason I love credit spreads is because they are, number one, really cheap to do, right? And number two, they're still like an option selling play, right? Without tying up a ton of capital. So I'm going to walk you guys through an example first, because I think that's going to be the best way for you guys to really see this whole thing in action and how it actually plays out, right? For this example, right now, we are going to be using Apple, and we're going to start with our put credit spread, okay? Now, we're going to go over to our trade options section. Now, this may seem a little bit confusing at first, but don't let it. Bear with me. I'm going to do my best to make this as simple as possible for you, okay? The first thing we do when we are doing a put credit spread is we are selling a put. I'm going to assume you already know what a cash secured put is. It's where, you purchase you're saying you're willing to purchase 100 shares of a stock, and if it hits that, right, you're going to have to buy those 100 shares, but you're also collecting that juicy premium, right? So in this case, we're going to go out about 30 days. Usually I like doing these on a shorter time frame, but for this example in today's video, we're just going to use our 28-day mark, right? So from here, it's selling a cash secured put as normal, right? That's all you're doing. You're just selling a cash secured put as normal, saying you're willing to buy 100 shares of stock. Now, you're not actually going to be buying 100 shares of stock, right? Because that's not what this strategy entails, right? So right here is where we're going to select the share price. I like to stick between a 0.20 and 0.30 delta. So let's take a look at 160s. Let's take a look at these 160s. We can see it has a 0.15 delta. Not really aggressive enough in my opinion. Let's go to 170 right here, 0.22. Okay, that's fine. So let's just, for the sake of this example, we're going to use this, all right? We now have a cash secured put, and we will collect $485 of premium income that's coming into our account from an options buyer. But we have to buy, right? Now we have to also buy a put. All right. Now we're going to buy a put. Let's just let me show you guys the whole example, because I don't want this to be confusing. Now we're not selling. We are now buying a put. Okay. Now what we're going to be doing is we're going to select, these are just all my strategies, guys. This is just how I like to do things. Obviously, go do your own research on whatever works for you. I like to then, for my put side, or my buy put side, go 5 strikes lower. Okay, so in this example, we're at 170 for our cash secured put. I go 5 strikes lower, so 165, right? That's 165. You're essentially buying this put as protection to protect yourself from any losses. Okay, that's what this buy leg is doing. So we're gonna click that right here, and you can see, right, in this example, right, that we would actually collect a total credit of $92 of income into our account. We'd collect $92. Now you might be wondering, well, why is it so lower? I just got, 490 here. Well, remember, you're now an options buyer. I know. Hit the juice button right on ourselves, right? They're taking our juice. But there is so much limited downside, right? Because you have protection. Essentially, right? All you are risking here is $500 of collateral. That's what you would need to pull off a trade like this. So I'm going to take our cash secured put calculator. Now it's not going to give us an exact amount. Actually, I'll show you guys the exact amount. Let me pull this into my screen. We are putting up about $500 in collateral. How do I get that? Well, that is the difference between the 165 and the 170. The spread between 165 and 170 is 500. Obviously, 5 differential times 100 is 500, right? So that is our collateral essentially that we are putting up. Now for that, we are collecting, let's just say $90 because it's kind of moving. Now, we put our 90 there. You're collecting about an 18% return on the collateral you're putting up. Big but here, because there's a few things that can actually happen here. I know some of you are like super excited because now your collateral isn't, for your $17,000, right? For that 170 put, it's only $500. But a few things can happen here. You have an actual loss that can happen, right? When you're doing a cash secured put, in my personal opinion, you don't really lose if you're doing it on good companies. Like, what's the worst case scenario for me with my cash secured put? Like, if I only do a cash secured put, I buy 100 shares of Apple at 170 when it's currently trading at 190. Okay, I got an asset, one of the most valuable companies in the world. Now, in this case, right, if we drop, right, your contracts will get expired and you will lose. Or they'll get exercised and you will lose money, right? You will lose that $500. Now, you don't actually lose $500. What we actually lose is we minus that $500 minus the premium we're actually getting, right? Because we're collecting, right? Our $500 is our collateral, right? That's the spread, right? But we're actually getting paid $90 of premium. So we're going to minus 90. Your actual collateral here is only $410. And the reason I like this strategy compared to buying options is I really have a clear defined risk. I know what my outcomes are going to be essentially, right? I know that I'm putting up essentially $410 that could just disappear and I lose that money. But that's a clearly defined max loss for me. Okay. Now, obviously, we're going to get a fantastic return, about 22%, and we're collecting some juicy premium. This is on the unfortunate reality if you don't have enough money to be able to do cash secured puts, right? Or like covered calls, which we'll be kind of talking about in just a second on the other side, right? These are still great options for small accounts, in my opinion. Now, there are risks. You can lose actual money, but that's a decision you're going to need to make for yourself to see if that's what you want to take or just save up till you actually can walk away with something. That's why I do typically like the wheel strategy and actually letting my cash secured puts get exercised, because at least I get something. I get an asset from this and I don't lose essentially anything, in my opinion. Okay. So this is called a put credit spread. Okay. Now we're going to be talking about the other end, right? Actually, before we jump into that, I want to give you guys, like, because some of you might be asking, well, when do I do a put credit spread or a call credit spread, which we'll be talking about in a second? Well, a put credit spread is similar to when you would open a cash secured put. Right? That it's as simple as that. When would you do a cash secured put? If you guys follow, the channel, you immersing yourself in the content here, you would typically do a cash secured put when you're towards the bottom Bollinger Band, right? Or blowing past it, right? That's when it's oversold, right? There's, obviously the market's crashing right now. That's a good time to do your put credit spread, exactly at the times that you would do cash secured puts. And the reverse is also true. With Apple, for example, obviously there's a lot in the toilet right now, is we would be doing our call credit spreads when we are towards the top of the Bollinger Band. Now, why do we do this? Well, because when we look at the Bollinger Bands, which is really the best indicator when you're doing your call credit spreads, your put credit spreads, we can usually see that we bounce off the top Bollinger Band and work our way down. Sometimes we don't work our way down for, maybe a month or two, but then we rebound off the top, off the bottom. We come back up. We rebound off the top, and then we come back down. And we kind of just usually are in the middle of these Bollinger Bands. And you want to take this into account with your spreads. What are those resistance levels that you need to be paying attention to, right? Like, for example, sometimes we drop well below, right? We drop well below our bottom Bollinger Bands. And that happens because nobody knows what the market's going to do. We're one headline away, as we see in this kind of market. So The reverse is true for the call credit spread, which we'll be talking about right now. Unfortunately, there's a lot just dumped in the market right now. So we're just, obviously, this isn't going to be a great time to do call credit spreads. This is a better time to do put credit spreads, but we'll just show you guys it as an example. Pretend Apple is at its top Bollinger Band, okay, for the sake of simplicity. Okay, so we'll now be back to Apple. I'm going to just close out these positions. Now, let's say we'll just start all over. We're back to Apple, and let's say we want to do a call credit spread. Okay, we'll go to Trade Apple Options. Now, what we're going to do is essentially simulate a covered call with protection by buying a call as well. So first thing in a covered call, right? What do? We go our 30 to 45 days out. We'll do our May 9th, right? And we're going to select the strike price that we'd be willing to sell our 100 shares. Now, we don't actually own 100 shares, right? So this is a bootstrap, right? So, but still, the same rules apply in my opinion, right? Pretend you do. Pretend you own 100 shares. So let's say you'd actually want to sell your 100 shares at 215. Let's take a look at these deltas. A 0.21 delta, that's a sweet side between a 0.20 and 0.30. Obviously, the more aggressive, the more premiums, right? So we will click this one right here, and that is a covered call. It tells us right there. Now we want to flip to buying a call as well. So we're going to click buy call, right? And we go 5 strikes up. This is just my rule of thumb. I like to just go 5 strikes up. That's just kind of how I like it. It's a good mixture of protection as well as making it actually worth it. One thing that you'll see, and I didn't mention this on the put side, is I want to at least make 20% on these. Like if I can't make 20%, it's like it's not worth it in my opinion, right? So like in my opinion, that's just what I like to do. I want to make at least a 20% return on a trade if I'm doing any kind of credit spread. That's just me. You have to go figure out what your own risk tolerances are, okay? Don't let somebody on YouTube tell you what to do. Go figure out your own financial situation, your age, your risk tolerance levels, all that good stuff, all right? So now we are buying a call as protection. Again, I like to go 5 share prices or strike prices up to our 220, right? Above it, all right? We're going to click that, right? And now you can see we are doing a call credit spread. How much would we collect here? About the same, $93, we'll say, just for this example, right? You can see it went up to 94, 95, but we'll just do 93. So we'll just use our cash secured put calculator here just to keep it simple. I know I have a cover call calculator as well and a bunch of other calculators. They're all free inside of our option selling mastermind group. It's a free Facebook group. The link will be in the description. Definitely recommend you join and vibe out. We got people always posting in there, the premium they're collecting. It's just a fun place to network with other people all doing the same exact thing. So we are collecting a premium of $93, right? What's our spread now, right? And I want you to really think through this yourself because that's how you learn, right? What's our spread? It's 5 again, right? It's $500 of collateral that we would need, right? We would need $500 in collateral, right? And we could see that when we go down to here. Now, it says what your max loss is 406. Well, why is it saying that, guys? Well, remember, right? We're doing 500. Right, and what was our cash secured put? What did we decide we were going to do? Premium was 93. So 500 minus 93 gives you that 407. Obviously, the market's open, so that number does change, but it's 407, right? And then we put that into our collateral here, and that is 407 for a return of about 20 to 23%. And it's a very similar strategy. One's bullish, one's bearish, right? And the way you decide which one is an ideal situation, in my opinion, right? Nothing here is ever financial advice, is by doing some technical analysis. Now, obviously, we all know technical analysis is a fugazi. Nobody knows what the stock market's going to do. Don't ever let anybody tell you that. If you watch somebody and they tell you they know what a stock's going to do, or they're telling you what stocks to buy, run the other way because they're just trying to sell you something. Okay, and that's the damn truth. Okay, nobody knows what the stock market is going to do. Okay, there is no one. Please, okay, use common sense. That's all I ask you, right? But we can at least give ourselves a thesis on why we do something, right? Because the last thing, and I speak to a lot of you guys, is the last thing we ever want to do is do something and not have a reason why we did something. And that's why this channel is all about education here. I just want to educate you to make educated decisions for yourself, right? So for me, when I'm doing a credit spread, I'm going to decide, look at my technicals, and give myself the best shot at least of winning and walking away with that premium and not actually losing money, okay? That's what I'm going to do. Okay, that's what I'm going to do. Okay, and I do that by looking at the Bollinger Bands. It's really the easiest way to kind of see what those support and resistance levels are. You can kind of see some historical data as well on where we kind of maybe jumped below it or above the top Bollinger Band. And I use that information to do my credit spreads. And to repeat that, for call credit spreads, I like to treat it just like a normal covered call. I like to be towards the top of that Bollinger Band because usually we retract. And when we retract, we can close out our call credit spread, right? So for example, let's just kind of make this a little bit more full circle. Let's say you did a call credit spread right around here. We were at 258. This would be a good time because we're at that top Bollinger Band. We're kind of surfing the top Bollinger Band here, right? This is a good time to do a call credit spread. And guess what? Fell off, right? Started dropping. Once it hit that bottom Bollinger Band, or even probably right around here, you would have been able to close out your call credit spread position and locked in some gains. Now, you might have had to give back a little bit of that premium that you got, but still, you would have probably made about 15% of your money, giving back a little bit of that collateral that you collected. In my opinion, that's great because these are a little bit more short time frames, in my opinion, that you're going here. You're trying to get in and out. I hate to say it, but kind of day trading in a way. Okay. And then, right, we hit the bottom Bollinger Band, right? This is where then you can then do your put credit spread. Now, you would have been a little bit scared here, right? Because guess what? You're surfing it way down. You're like, oh my goodness, I'm going to lose my collateral. But guess what? Then we start to recover. Right? We came back, we were kind of messing around here. And if you did it about a 30-day one out, you would have been most likely able to close out your put credit spread once we worked our way towards this top Bollinger Band. There's a good mixture of what your risk tolerance is. Me, usually I like to do weeklies on credit spreads personally, right? Because I have the time to kind of be able to check my entries and all that stuff. Most of you should probably stick to 30 to 45 days out because obviously, as you can see here, time helps you. Time does help you. Now, obviously in a situation like this, let's say you did open up a put credit spread here while it was right here, right? At this 209, right? Blown past the bottom Bollinger Band, and you waited a month, you would have lost. Right? You would have lost your money. Actually, maybe not. Actually, no. Yeah, you would have. You would have lost if you did a 30-day. Well, we still have a few days, so you never know what could happen. But right here, you most likely would have lost your collateral. And that's the risk that you need to understand when you're doing credit spreads. Guys, I have a very special giveaway. I'm doing these now. You have to watch the whole video to see what these ebooks are that I put together. You guys know I love putting it together, these one-pagers together, because for me, I just like all these strategy stuff. I don't use them all of the time. Again, I'm mostly a wheel kind of guy and quad options kind of guy. So I always like to have refreshers and one-pagers. I have a bunch of ebooks that I've developed for myself and my simple man's brain. But there's a strategy called the Iron Condor where we actually combine both of these strategies together. I have a one-pager on the Iron Condor that I want to share with you. All you have to do to get that is drop a comment down below. I will reply to you by tomorrow's video with a link for that, as well as all the details you need to know on how to execute the put credit, call credit spread together in an Iron Condor fashion. It's a little bit more an advanced strategy, but definitely great for those of you that are more on a budget. So make sure you drop a comment and then make sure you also like this video and subscribe to this channel. Guys, I also have a year-long incubator that I work with a very small group of clients on, where I show you guys how you can actually start building an option selling income portfolio for yourself. I believe this is the best strategy for 99% of people out there, and they have no idea it even exists. It absolutely changed my mindset on the markets entirely. Why buying and holding stocks is never really a good thing. We're just doing like ETF buy and holds. So I have a small group, and if you're interested in learning more about that, on how we can work together on building you out an option selling income portfolio for yourself, make sure to head down below in the description of today's video. There will be a link for that. You can watch a 30-minute masterclass to see more about what we actually do here, and you can apply to book a call with us. So make sure you take a look down below in the description of today's video for that link. Guys, remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.